I'm Roland Breitacher. I have actually a short question and then another one. The first one is, how do you determine on value investing your discounted future cash flow for the next 10 years? The other one is, do you consider 10 different positions in a private portfolio enough, or should it be 15 or 20?
Yeah.
And then I have another one, sorry. This concerns Alec's latest portfolio he proposed with tech shares.
And I keep that one for David Shapiro, please.
Oh,
We're on the other, we're in a different camp.
Okay,
And I'm
good.
joking, I'm
All right.
joking. No, Roland, I was joking, please.
I'm
Sorry?
happy to talk about tech.
Oh, were you joking? Okay. No, it was a short question. It's it refers to the expression catching a falling knife. I took your 10 or 12 shares that you put on your website in end of December, and I made a sample portfolio with them, exactly as you did, $10,000. Shortly thereafter, beginning of January, these shares the whole tech sector dropped. And yet you, in a second tranche, you still went and bought your second tranche. Is it
With my own money, by the way, and a third tranche.
And
my
the
own
third,
money,
okay. What is I know there is a rationale behind it, but wouldn't it be better when you have a trend that's falling to wait for a month and go the next month or following months?
Okay, well, that's not
That's
a question to Piet. But anyway,
I'm finished now.
I'll give you the response to that.
So discounted cash flows, how do you do that? It's not hard. When you understand a business, you understand the revenue opportunity they have, whatever the business is. Say it's a car dealership. You understand how many cars they on average will sell this year, and if they grow by the economy rate of growth, say 5 or 6% nominal, you can project those cash flows into the future. You know what the margin of a car dealership is, probably around 3 to 6%. You can work out their margin, look at the balance sheet, deduct tax, deduct interest, that's the cash flow. Work out what they need to reinvest for new stock, the capital requirements. What you want to get to is a free cash flow of the business, which you can do upon analysis, understanding the business, and you can project that out to the future, because most of these businesses will grow along with the economy, and the economy grows at a fairly steady nominal rate every year. I mean, we all get excited about GDP numbers, which come out and it's down 3%, but those are annualized quarterly figures. The economy sort of grows. Some years it's flat, but it grows by 3 to 5 to 6% per annum, and you can build those growth rates into your projections. And then you must work out for yourself what you think your discount rate is. I have very low expectations, so I use quite a high discount rate. I use 15%. But it's up to you to decide what discount. There isn't a rule which says this is the right rate or that's the right rate. It's your own personal preference and your own risk tolerance which will determine what discount rate you use. And then you discount those cash, and that's the value of the business. It's as simple as that. It's no more, no less. And whether it's a student apartment or a car dealership or a shoe business, it boils down to the same type of analysis. So that's that. In terms of diversification, I think there's been studies shown that I think it's like 17 or 20 shares gives you good enough diversification that if you add any more to that, you're not getting any more benefits of straight up diversification against the market. I tend to buy more shares than that because of liquidity constraints in the market. You know, if all the shares are big and very liquid, then I'd have a lot fewer shares, 20 or 25. But because a lot of the value situations in South Africa are so small and so illiquid, you can't fill up your portfolio with those stocks, because if the clients want their money back, when you're running a unit trust, you always have to be in a position to be able to give the client their money back. And if you're sitting with a whole bunch of illiquid stocks, you can't do that. So that's a risk you need to manage as well. So anywhere for, proper diversification, anywhere from 20 stocks up is, I would say 10 is probably too few, theoretically. But again, that depends on your own risk tolerance, because everybody is different. And then if I can just touch on the last question, Just because you buy something and the share price goes down doesn't mean you're wrong. And also, if you say, let's rather wait for the share price to go down before we buy, at what point do you buy? How far down does it have to go before you buy? How do you know you're at the bottom? And what I'm trying to say is you don't know. When you buy an asset and the share price moves, it doesn't prove whether you're right or wrong. If you buy an asset and the share price goes up, means nothing. You're not right. You'll be able to say you're right in 5 years' time or 10 years' time. Then you can say you were right. Anglo's was 50 Rand in 2015, and in 2022 it's 750 Rand. You were right. You can say that. But if you buy a share in January and the share price goes down by the end of January, you're not right or wrong. It's meaningless. It means nothing at all. That's my opinion on that issue.
Next question.
Hi, Piet. My name is Enrico Knudsen. I'm from Stellenbosch. You must please forgive me. Maybe this is a curved ball.
Those are the best ones.
Can you explain the rationale for investing in the CNA and what the expected future is for CNA?
Yeah. So I can tell you what the expected future for CNA is. Very poor. It's probably as bad as you can think it is. So we invested in CNA, and this was in our private investment company, not in the Counterpoint Unit Trust. We invested in CNA because a person brought the transaction to us, and we structured it so that if something went wrong, we could walk away without having put any money in. In other words, we would not lose money. All that we lost was time in dealing with people who turned out to be not great people. So we invested on the basis of a structured transaction which had no downside, and if it worked out, we could have made quite a bit of money. As it turns out, it didn't work out, and the structure saved us from losing money. So, as investments go, we're quite happy with that one.
Also, where are the other microphones? Is one in the front? Danita, right here in front. Okay.
Hi, Pete. Cameron here. So I know you're a big fan of Warren Buffett, and one of my favorite quotes of his is, "It's only when the tide goes out when you see who's been swimming naked." So my question to you today is, who in the market is currently swimming naked? And just as an add-on question, you describe the value of a business as the present value of all future discounted cash flows. Based on that description, I just struggle to understand why you hold crypto, because it produces no cash flow. Neither does gold, by the way. So yeah, I just want to get, why do we hold assets that we don't fundamentally believe in actually hold asset value?
So let me answer the second part of the question first. Crypto, gold, currency. Why would you hold currency? Because it also doesn't produce cash flows. But in the US and Europe right now, in fact, you pay banks to put money in the bank. So money is the same thing. The reason the future cash flows for an asset like gold or Bitcoin or even cash is that there is a circumstance or a set of circumstances in the future where you can sell that asset for much more than you paid for it today. And that's the cash flow. So it's a bullet cash flow 5 or 10 years down the line. And if the present value of that bullet cash flow 10 years down the line is a lot more than the current price, well, then it's an investment. And that's how one would think about investing in gold or any asset that doesn't produce a regular stream of cash flows like stocks do with dividends. So that's the rationale for that. There is a certain set of circumstances under which Bitcoin can be worth a lot of money. And it's those set of circumstances which will make other parts of your portfolio worth a lot less money. So it's a nice hedge against certain types of outcomes. And what was the first part of the question? I forget that now.
Just repeat it, please, Cameron.
Oh, no, you'll only find out afterwards. I think we're busy finding out in certain tech type stocks that people have been swimming naked. We're busy finding that out. But those things are only really evident in hindsight, and then it's fun to talk about it if you weren't involved in them. But those are only evident in hindsight. But I can guess that when stocks are trading at 50 times revenue and crazy numbers like that, then people are swimming naked. Somewhere people are swimming naked. and we'll find out where.
Good afternoon, Pete. It's Alan. I want to ask you two questions. One is, what's your opinion on metals in the cycle, industrial metals rather than precious metals, with reference to MERAF? And the other question is, do you ever adjust your discount rate to, which is affected by interest rates generally?
Yeah, so the outlook for the commodity cycle, base metals, industrial metals, I'm quite positive on the outlook there. And it's to do with the supply of commodities generally, and specifically base metals, industrial metals. I think it's useful when you think about a cycle to think about the supply of an asset, not the demand for asset. Most assets that have been, non-new assets, like when the new iPhone came out, in 2007, this demand for it was inelastic and infinite. But for something that's been around for years and years and years, the demand for that asset generally grows with the economy over time. So it's a demand that's pretty steady for those sort of things. So you can't analyze cycles in terms of demand. So, oh, China's demand is going to drop, therefore the demand for the asset is going to drop, or maybe because of the war in Ukraine, demand for this is going to drop. I think that's a wrong framing of the problem. The correct framing of the problem is, what is the market doing in terms of supplying enough of the product to satisfy the market's natural demand for that product? And if the supply is too much or too little, prices will adjust to make supply meet demand. And what's happening in most commodity markets right now is supply is constrained. Supply is constrained for a number of reasons. The first reason is ESG considerations. Nobody wants a new mine or a new oil well to be drilled, like this ridiculousness off the east coast here with Shell being stopped from getting interdicted against them drilling a well there, or doing sonic testing and stuff. We're going to be hungry and cold, and then we're going to want that gas. So that, in a microcosm, is what's happening in the world. They can't drill new oil wells. Nobody wants a new mine in their backyard. But in the meantime, we all want electric vehicles, and we all want wind turbines. We all want photovoltaic generating systems. But those things take metal, and they take oil to create the plastics with, and they need energy to build. And they need all sorts of commodities to build those things. But we're not allowed to produce those commodities because of ESG considerations, because of fish in the ocean and things like that. And we're going to end up being cold and hungry, like what's happening in Europe. And prices are going to go up a lot. They've already started going up a lot in oil and other commodities. And I think that will continue until people are cold and hungry enough to say, okay, you can drill that oil well now. We need that energy. We can't cope without that energy. We need more iron and steel to build wind turbines. We need more whatever, ferromanganese for the aluminium and for the steel to build this whole new electrical network that we need to build to have clean energy. Prices will adjust to create the incentive to produce those commodities, but it hasn't happened yet, and prices are up a lot, and still mines are paying out dividends, buying back shares, and not investing in even maintaining capacity. I mean, the reserves of most mines are declining. They're not even investing in maintaining the reserves, let alone expanding the reserves. So I can see a long time period that prices for most commodities will be at elevated levels until supply is incentivized. So that's a long-winded answer, but that's what's happening out there in the market. And the question on
discount rate.
Discount rate, yes. I think you can adjust your discount rate based on circumstances. So if inflation is 5, you'll have a different discount rate than when inflation is 20%. There's no doubt about that.
Hi, Pete, Gary here. There's been quite a procession off the JSE recently, and more news this week of what used to be a small to mid cap and now a large cap leaving. The question is, does this make your job easier, or does it make it more difficult?
That's a good question. It makes it more difficult in that choice becomes less. So there's only like 250 investable shares in the JSE left. But if you look again at the supply and demand situation, there is a very low supply of equity to invest in for investors in South Africa right now, which means that over time prices will have to go up because it's going to have to incentivize companies to list again. If prices stay low, which means share prices are low, which means cost of capital high, which means returns to investors high, if that stays that way, that's a great place to be because you're going to earn fat returns. So by and large, when you have delistings happening and the supply of stocks contracting, it means assets are cheap because entrepreneurs are not interested in selling equity to me and you at low prices. They'd rather buy it back from us and go private. The time to be wary of the market is when there's lots of new listings and people coming to market, because entrepreneurs and business people are smart. They know the cost of capital. If capital is cheap and people are willing to finance their business at ridiculous rates of return, they will take advantage of it and they will sell their equity to you. That's what an IPO is, the entrepreneur selling his business to you, the investor. It's not being nice to you. He's selling a part of his business at a high price. That's the dynamic. And when companies are going private, that guy's not being ugly to you. All he's doing is he is buying back his business because he recognizes it's massively undervalued. So again, that is the meta narrative of what's happening right now. Businesses are cheap, they're undervalued, and entrepreneurs are taking the price. They're buying the whole business themselves because investors couldn't care about it.
Final question in the front.
Piet, Ian Forbes, my name.
Hi, Ian.
If you were going to invest a substantial amount of money now, what would your spread be between offshore investing and SA investing?
That's a very good question. And I do manage a fund which does exactly that.
And one other question, if I may
sorry.
just add to it.
I'm so excited to hear that question. I just want to start answering.
You mentioned Lewis being, let's call it lazy balance sheet, too much equity, too little debt. What would your view be on debt to equity as a ratio?
Yeah.
Thank you.
Okay, so the first question in terms of how much would you own offshore versus onshore, again, that's every person has different circumstances and has different liabilities that they need to make sure they can meet. If all your liabilities are in South Africa, it would be irrational to have all your assets offshore. Because there is a chance, I'm not saying it's a high chance, but there is a chance that the rand can appreciate significantly from here, where it is today. There is a world in which the rand strengthens a lot. That world, interesting enough, is one in which there are global capital controls, there's wars on the go, commodity prices are very high, and we produce lots of commodities. That's sort of an environment in which the rand could potentially be strong. So if you have lots of liabilities in South Africa, you would be irrational to have all your money offshore. So you need to, again, manage your risk. For me right now, in terms of a pure investment view, given the cheapness of assets in South Africa versus the expensiveness of most offshore assets, specifically US assets being very expensive. Right now I'm running that fund at about 40% local, 60% offshore. And the 60% offshore has almost no exposure to the US. It's mainly emerging market exposure and commodity exposure. But that's a fund I manage, and that's my view, and my own money is invested in that fund, so that's my personal approach. Different people have different approaches and different risk profiles and different risk appetites, and each one needs to decide that for himself. But one of the factors that you need to take cognizance of in this deliberation of how much onshore, how much offshore is assets here are cheap, and secondly, your liabilities are mostly here. And different people have different liability profiles. So that's the one question. Very quickly.
Debt to equity, yeah.
Yeah, debt to equity. Look, again, if your business can sustain it, you could have 95% debt and 5% equity funding, and the return on the equity would be through the roof. It'd be fantastic. But if a business were to be financed in such a risky way, and it hits a bump in the road, the banks take control. and the banks start calling the shots, and you lose control of your business. So that could lead to very high returns on equity, but it could lead to you also losing control of your business. So I would say you want to probably err on the side of conservatism when you finance your business, but it's smart to use at least some debt, because the cost of debt is lower than the cost of equity. Equity is expensive financing.
Peter, our time's out, but I can't let you go without giving us an update to the bundle.
Well, I think the fact sheet, the fun fact sheet right there in front of you, and some of the most exciting stocks today for me are fairly large cap companies. It's companies like Exxaro, Sasol, Tungela, the coal company. Well, it's not in the top 10 there, but it's a holding. Energy businesses, I think, are fantastically attractive, especially dirty energy businesses, because supply of energy is constrained, and the prices of those things will continue going up until supply is incentivized. So those things are quite exciting to me.
Thank you, Piet Viljoen.